Warren Buffett started buying shares of Coca-Cola stock back in 1988, and at that time it had a price-to-earnings ratio of 18. A PE ratio of 18 meant that for every $18 worth of shares that they were purchasing, they were acquiring enough ownership in the company to have a right to $1 of its annual earnings. Coca-Cola's earnings at that time were growing by 16%, so nothing too crazy, but still a nice, strong, steady growth rate, and they were expecting earnings to continue to grow at a nice rate for quite some time. So that's an example of a pretty straightforward and rational investment. And when making that decision, Buffett and his business partner Charlie Munger were thinking about how solid is this company's financial position, how much money does the company make, how much money is the company expected to make in the future, and then finally, is the current price that the shares are trading at cheap enough to make it an attractive looking investment or not? So how did that investment turn out? Well, they spent a total of $1.299 billion on that investment, and now those shares have a market value of almost $21 billion. Now, without dividends, that's a 9% compounding annual growth rate, which is still quite decent all things considered, but once you include the dividends, the picture looks even nicer. In the year 2020 alone, Berkshire Hathaway, Warren Buffett's company, collected $656 million in dividends, which is about half of their initial investment, which they made 32 years earlier, paid to them in one single year. Hypothetically speaking, if all dividends received by Coca-Cola over the years were immediately reinvested back towards buying more shares of Coca-Cola stock at that moment, then the compounding annual growth rate between 1988 and right now in May 2021 would be closer to 18%. Now, the topic of how to analyze a stock before buying could totally be the subject of an entire multiple hour-long course. And even more than that, it's really something that you could just continue to improve at over your entire lifetime. Nonetheless, in this video, we're going to cover the most important things to know when it comes to analyzing a stock before buying. But first, let's actually cover what analyzing stocks is not about. Analyzing a stock does not mean reading articles online which were probably written by minimum wage journalists, and analyzing a stock is also not about going onto Facebook groups or reading through YouTube comments and looking for clues on the next hot stock that's going to explode. Instead, I'm talking about taking a more rational approach and thinking about shares of stock as ownership in a business, which is what they are. All right, so before you can get to analyzing a company, how should you go about choosing which companies to even look at to begin with? So first of all, if you already have some companies in mind because you're a customer of them and you use them in your day-to-day life already and you think they're a great company, that can be a great place to start. Understanding a company and understanding how they make money is important before you buy shares of it. And if you already are a customer of the company, you're naturally gonna have a much better understanding of it. So yes, it totally makes sense to look at the companies you already know. Now let's say though that you've looked at all those companies and none of them are looking all that appealing right now at their current prices. How else can we find potential stocks to look at? So for that, we can use what's called stock screeners. There's a few free ones available online. This one's called FinViz, and with it you can enter some parameters to filter potential stocks by. For example, you can make it so that it only shows you stocks with PE ratios below 20, return on invested capital above 15%, and estimated earnings per share growth over the next 5 years as positive. Then you can simply sort by PE ratio and start working your way down the list. Now to begin with, as you're going through them, I would suggest avoiding the financial companies like banks and insurance companies, at least at first, because they're a little bit more difficult to analyze. And I'll also mention that when it comes to using stock screeners, you could continue to add more filter parameters to further narrow down the list. However, if you do that, there's a good chance you'll end up filtering away some potentially good investments. So I personally find it better to not make your filtering parameters too restrictive and instead keep it more broad so you'll get more results and then just turn over more rocks. They say that the investor that turns over the most rocks will be the one that finds the greatest opportunities. Another free stock screener can be found at magicformulainvesting.com. Now the parameters for this one are built in, so the only thing you can adjust is the minimum market cap of the company. This screener ranks the top 30 or top 50 companies above the market cap you enter using a combination ranking system, which puts companies that are both cheaply priced and also have high returns on invested capital at the top of the list. So right now we're seeing the top 50 companies which have a market cap of at least $3 billion. And then again, from here, you can just work your way down the list. And also if you see any names that you recognize in the list, then you could start by looking more in depth at those ones first. So let's take a look at this one here, Sprouts Farmers Market. A nice website to see some at a glance information about a stock is this website, quickfs.net. So in this case, it tells us that Sprouts is a healthy grocery store chain that was founded in 2002. We can also see metrics like the price to earnings ratio, the price to book ratio, price to sales, enterprise value to sales, etc. Here we can see 10-year medians for return on assets, return on equity, and return on invested capital. And also we can see 10-year medians for profit margins. And here we can see the 10-year compounded annual growth rate figures. So this tells us that the company is growing its revenue by 28% annually, growing free cash flow by 52% annually, and growing earnings per share by 52% annually. We can also see up top here the current market cap and the current enterprise value. The difference between market cap and enterprise value, by the way, is that enterprise value factors in cash and debt. I like to think about enterprise value as the true cost to buy the entire company. Now let's go check out the investor relations page for this company, which most companies will have. Here you'll be able to find their annual and quarterly financial statements and what's called their 10Ks and their 10Qs. And sometimes you'll also be able to find investor presentation slide decks, which will also give you some more information. If you can find an annual letter to shareholders, those are also good to read because it gives you an idea of how the CEO is thinking. And then you're going to want to read through their most recent 10K reports. In there, you'll find a thorough description of the business, risk factors, management discussion, and analysis of the financial condition, and of course, the financial statements. When we look at the income statement for Sprouts, we can see that sales for 2020 increased over 2019 sales quite nicely in spite of the quarantine situation, so that's pretty cool. Cost of goods sold, and then gross profit. Then moving down the income statement, we can see that after operating expenses, the company is left with income from operations of $391 million. And then after interest expenses and taxes, we're left with $287 million of net income, which is definitely pretty reasonable for a company that's growing and would only cost you about $3.2 billion to purchase in its entirety right now. Then we can look at the cash flow statement, which I'm not going to go in depth into in this video, but this financial statement basically shows you how the cash is being used within the company. So for example, this here shows that they used $288 million towards paying down debt. And then finally, we've got the balance sheet, which shows you the company's assets and liabilities. This statement can help give us an idea of how strong of a financial position the company is in. We can see here that they don't have a lot of debt, at least relative to how much money they make. Just $260 million of debt now left over after that $288 million that they recently put towards it. And that's actually something that I do like to see in a company. If a company could pay off all of their debts in less than 3 to 5 years, then that's a pretty strong position to be in. There are some companies out there which I avoid that have so much debt that even if they put all of their earnings towards paying it off, it would take like 30 years to pay it down. And personally, I don't want to own that type of company. Sprouts could pay off the remaining debt in less than a year if it wanted to, so I like what I see in that regard. Another thing I'll point out here, by the way, while we're looking at this balance sheet, is that one thing you might hear when you're learning more and more about investing and picking stocks is that it's good for a company to have a current ratio that is greater than 1, which would mean that its current assets are greater than its current liabilities, which in this case with Sprouts, they're not. Now, the idea behind this advice is that if a company has less current assets than current liabilities, that it could mean financial troubles ahead for the company because the company might not be able to satisfy their current liabilities. However, from my experience, I wouldn't hold too much weight to this. And I definitely would not add it as a parameter to a stock screener to filter out companies that have below 1 current ratio. And that's because if you did that, there'd be a good chance you'd be filtering away and out of sight some great companies that you otherwise would have found. So although Sprouts has less current assets than they do current liabilities, they also generate a healthy amount of cash from their operations, and so they should be able to manage their current liabilities just fine based on everything that I'm seeing. Now, the next thing I'm going to show you in this video is how to actually value the company and figure out how good of an investment it is right now in terms of what sort of annual returns you might be able to expect from buying it right now. So here's a little spreadsheet that I whipped up and I'm going to quickly walk you through it. Here we have the share price, which I just grabbed from searching on Google. Here we have the number of shares outstanding, which I pulled from the income statement right here. Market cap now is just the share price multiplied by the number of shares outstanding. The amount of cash they have, I grabbed from the balance sheet, and same goes for how much debt. Enterprise value, therefore, is just the market cap, subtract cash, plus debt. Then enterprise value per share comes from dividing the enterprise value by the number of shares outstanding. I like to think of this as the true cost per share once you've factored in the cash and debt that you're also acquiring with your purchase. And then here I've entered the earnings per share over the past 10 years, which I copied and pasted from quickfs.net right here. This part of the chart you're looking at is those figures plotted in a line chart. And then up here, I've put 3 different scenarios. best case, okay case, and worst case, which I've added an estimated growth rate of 15%, 5%, and negative 10% for, which is then also plotted below in green, blue, and red. Now here we have the IRR for each of these possible scenarios. This means that if our best case scenario plays out, then it would be an investment that should provide us with 20% annual returns. If the okay case scenario plays out, then the return should be around 12 or 13% annually. And if the worst case scenario plays out, it would be an investment that would provide you with annual returns of just 3%. Then I've also assigned probabilities to each scenario, which produces another series of future earnings projections which aren't on this line chart below, but which have an IRR of about 14%. And really the only purpose of this one is just to help give you a reasonable estimate. Now making estimates about the future is tough, and that's why being conservative in your estimates is important. So from this point, what you can do is you can continue to look at other potential companies and really just go through the same exercise and make yourself a list of potential investments, and then decide which ones you like best. In this video, I'm not trying to say that Sprouts is the best investment you can make right now, so hopefully that's not what you're taking away from this. It does for sure seem like a decently priced company considering that it's growing and how much cash it generates. But the bottom line is that hopefully you now have a better understanding of what it means and what it looks like to analyze a stock so that you can make better stock picking decisions in the future. To quote the great investor Peter Lynch, you should spend at least as much time researching a stock as you would choosing a refrigerator. If you want to learn more about how to value a company and the discounted cash flows calculation and the IRR calculation, check out this video right here. Taking a rational approach to investing can be super financially rewarding, of course. Case in point, Warren Buffett, one of the richest people in the world, not to mention that pretty much all the billionaires of the world got there by either building or buying businesses. And besides that, if you're someone like myself that wants to reach complete financial freedom and wants to do so in a strategically sound and systematic way and doesn't want to gamble with their money, then it's really the only way to go. In my opinion, if you understand the fundamentals of investing and you take some time to rationally think before you buy, you're almost guaranteed to beat the market. However, you're also going to have to become good at one other thing, which is being okay with some people around you getting richer faster than you sometimes, right? Because gambling sometimes does pay off, and those big winners might get rich faster than you. Leading up to the dot-com bubble stock market crash, people were making tons of money. At least on paper they were. And everyone wanted to get in on a piece of the action. And also no one could bear the sight to see their neighbor getting richer faster than they were. So it was this combination of greed and envy and fear of missing out that drove the stock market to ridiculously high and completely irrational prices before eventually the bubble popped and wiped out nearly 80% of the Nasdaq's value. That's just kind of the way it is. There's been plenty of asset bubbles in history that have played out the exact same way, and there will be plenty more in the future. It's super tempting to think that you can time the market by buying at the right moment and selling at the right moment too, but countless studies have shown that trying to time the market just isn't possible. And speaking for myself now, I know that my quality of life would be much lower if my financial future was built on such a fragile foundation. Now, buying the greatest companies like the Googles and the Amazons of the world and planning to hold them forever is definitely better than trying to time the market, for sure. However, the problem with this is that you're most likely going to end up overpaying, which in the long run will make your investment returns pretty mediocre. So the conclusion that I come to is just to take a rational approach to the whole thing, stop trying to get rich quick, and start treating shares as the business ownership that they are, and then making sure you're paying a rational price when you're buying them. Please remember, I'm not a financial advisor, I'm just someone who loves business and loves investing, so talk to a qualified pro before you take any action on any of my content, and I'll see you in the next one.